everyone. As you can tell, just started the recording of this. Thank you all for being here. I'm Maura Collins. I'm the Executive Director of the Vermont Housing Finance Agency. I've been working with several others who will be introducing themselves on pulling together this conversation today about multifamily affordable housing insurance. The origin of this conversation was born out of a conversation among a lot of Vermont's nonprofit affordable housing providers who were talking about the impact of insurance, the fewer bids they're getting, the less coverage, the higher cost premiums, and the like. And there was an interest in the nonprofits coming together and talking about their shared experiences. And then with that, we thought about inviting our public housing authority partners, the for-profit affordable housing managers, fee managers, owners, and others. Vermont's Department of Financial Regulation is with us. I know that some of our congressional delegation staff is listening in. And I even think we have a couple New Hampshire and Maine folks who wanted to listen in to the conversation to see what Vermont is experiencing. So you will see that you are muted. You will have a chance to unmute when we get to the Q&A part at the end of the discussion, but really we're about to kick this off into several different presentations that we'll walk through. And then at about halfway through our time together, we'll shift over to more of an open discussion. And at that point, you can use the Zoom feature to raise your hand. I'll unmute you and we can have more of a collaborative discussion. So to start us off, I want to introduce my friend and colleague from outside Vermont, Tom Amdur, who will introduce himself, but I will put in a plug that Tom gave a presentation similar to what you're going to hear today at a national event that I was at of all the state housing agencies a few months ago. And it really generates some deep discussion. So I look forward to hearing what you have to say, Tom.
Well, I really appreciate the opportunity. I'm going to share my screen, so hopefully this will work. All right, hopefully everybody can see it. So a little bit about my organization, and this isn't meant to be an ad for Lincoln Avenue Communities, but just hopefully providing a little bit of context on why insurance is really important for us. So we're a large affordable housing developer. We work all over the country. We're surrounding Vermont, but don't have any work in Vermont yet, but doing work in New York and New Hampshire right now, and soon we'll have projects in Massachusetts, and I hope in Maine and Connecticut and Rhode Island in the next couple of years too. But a broad portfolio in a lot of different geographies. And my role within the organization, many of you may know me from my past life when I ran the National Housing and Rehab Association. I lead all of our affordable housing policy initiatives, as well as our resiliency and sustainability and resident impact efforts within the organization. And I never really thought insurance would be an issue that I'd become very passionate or enthusiastic about. I won't claim to have been much of an expert on this 2 years ago when I joined Lincoln Avenue, but what came to pass for us recently in our last insurance renewal in March of 2023, we're actually just finalizing our 2024 renewal right now. We had quite a shocker, as I'm sure everybody on this webinar has had as well. We had on average more than a 50% increase year over year in terms of our premiums, and we're a large organization with scale and diversity, relatively low loss run history. So this was quite a challenge for us. And that premium increase, I just want to also point out, and I'm sure this is the experience lots of other folks have had, that was for qualitatively worse coverage. So higher deductibles, more exclusions, and just like I guess can't remember who said this, but when you're a hammer, everything looks like a nail. Well, I'm a policy guy, so when I see a problem within our organization, the first thing I do is I try to see if there's a policy solution. And then over the course of the last year and a half, I've really been doing a lot of work really with our industry colleagues, our coalition partners, our trade associations, and internally to really wrap our heads around the issue and, as we'll get to later on in the discussion as well, what are some of the potential solutions that we might be able to achieve to hopefully make this less of a problem in future years. So what are the big drivers that are impacting our experience today? Natural disasters, largely climate driven, are the big, is one of the biggest drivers. So you've probably seen this slide or a similar slide in other presentations. In 2021, we had 20+ billion natural disasters. As you can see, it's geographically dispersed and lots of different types of disasters. So fires, droughts, flooding out west, derechos in the Midwest, hurricane, hail, tornadoes. Was a bad year. 2022 wasn't a whole lot better. We had $18 billion+ cat events. And what I think is sort of interesting, if you look at this slide and you compare it to the last one, slightly different geographies, slightly different fact pattern, a lot of the same types of events, but in different places. What's new on this particular list is severe winter storms in the Northeast and flooding just about everywhere else. And 2023, I think this really hit home in Vermont in particular with all the flooding that y'all experienced last summer. Wasn't as bad a hurricane season, but it wasn't really any better in terms of total number of major cat events across the country. So 28 separate billion-dollar disasters, again in different geographies from 2022 and 2021. And what I found really interesting, it's not on this slide, but this will tell you that climate is a real issue. 90% of all U.S. counties experienced a major cat event in 2023. So this is an everywhere problem. Not all of them are billion-dollar problems, but this is really something that we are experiencing with a lot of severity. So even out in Hawaii with the wildfires as well. And from our company perspective, we operate in a lot of these markets that we just highlighted, and that's really playing out in our insurance renewal. 2024, we haven't hit the major hurricane season yet, but we've already had $1 billion natural disaster, and this is not sort of the typical time of year that we would tend to have a lot of natural disasters. That really kind of amps up in the summer as we have the storm season. So who knows what we'll experience in 2024, but I don't think there's any reason to expect that this year, next year, and the following year are going to be any different. But the geographies will change as we're going through, what are we in, like an El Nino cycle right now? So I can just speak from our own personal experience with our headquarters out in California. Obviously, we're experiencing a lot of these atmospheric rivers that have resulted in flooding and landslides. So this is just to say climate is a big issue. And if climate were the only issue, well, that would be something that we could presumably plan around, but it's not just climate. So we have increased claims from climate disasters and increased frequency, okay. But inflation's a big driver as well. When you're out there and you're buying an insurance policy, you're measuring your risk and then you're measuring your replacement costs. And if everything costs more because of inflation, your total insurable values go up and you have to buy more insurance. That is certainly a factor brought on by all the supply chain and cost and inflationary economic issues that we've all been experiencing that have been just making affordable housing hard to develop anyway. Obviously, interest rates have gone up as well, and that makes it more expensive to borrow, but it also actually affects insurance company profitability, which is not something that everybody would necessarily think about. So insurance company profitability, more claims, less profitable, generally speaking. But you also have to think about what insurance companies do with all those premiums that they collect. So they reinvest them. And the insurance company business model, overly simplified, is collect premiums, reinvest them in some sort of yield-bearing security, and then pay out claims. And hopefully, the investment income plus the premiums is more than the actual claims. Well, a lot of these insurance companies were invested in these low yield bonds, and then when the interest rate environment changed, all of a sudden they had the same problem that Silicon Valley Bank and First Republic and those banks that struggled and some of them failed last year because they were sort of upside down on their investment and return dynamics. That's happening over for the insurance companies too. So just from that dynamic alone, premiums are going up on a non-risk adjusted basis just because they have a lot of paper on their books that is not yielding what their current expenses are, which I mean, I don't have a ton of sympathy for insurance companies right now, especially when you read the headlines about, their record, 2023 being a record year of profits for them and the stock prices going up and all of that. But that is a factor that's been playing out in your policy renewal. Then there's also just less competition. And that was particularly a big factor in 2022 and 2023. When you think about insurance and reinsurance in particular, it's capital seeking return. And after having a bunch of years of bad returns in the insurance markets, a lot of that capital was deciding, oh, I don't want to be in these higher risk markets, or I don't want to be in the insurance business at all. Reinsurance in particular, a lot of the capital behind that are big investment firms like Berkshire Hathaway or sovereign wealth funds or foreign pension funds that can deploy their capital in other investment types other than just insurance. And a lot of them have chosen to do so historically. So less insurance capital, less competition, less people bidding for your property, that drives up prices as well. Also, this is just I don't know if this is a good fact or a bad fact, but a fact anyway, that something like 50% of all global insurance claims happen in the United States. And we're certainly not 50% of the property policies or the casualty policies. But there's something about our claims environment that is different than Europe, where there's probably similar levels of insurance on people's books. So just from a global risk allocation perspective, a lot of those global players in the insurance space have decided they're over-concentrated in the United States. And so they're deploying their insurance capital in other markets that that may seem either safer or just more diverse, so they're not over-concentrated. Then you also are hearing, and I know I'm just like spitting off a lot of facts here, but you also hear, and we're certainly experiencing that affordable housing in particular is being treated differently in the marketplace. There are studies that have shown that the use of crime scores and crime data in insurance underwriting seems to disproportionately affect affordable housing. I mean, I can tell you from our own personal experience that when we shop our policies individually, we've got brokers that say, oops, I didn't realize you were affordable housing. We don't do that business. And that's a factor as well that we're experiencing as owners. It looks and feels and smells a little bit like redlining or discrimination to me. Whether it meets the legal definition or not, I can't say, but it's definitely a factor that's out there. And then on the casualty side, so mostly what I've been talking about so far has been on the property side, but on the casualty side, there's been an increase in claims as well. And I think what people are experiencing in their renewals this year is maybe a little bit of flattening in the increase of premiums on the property side, but an increase on the casualty side. What's driving that? Increasingly, it's these large claims in civil courts, judgments that have been passed through to the industry. More claims are being defended longer because private equity has gotten, plaintiff claims, I should say, has gotten into the business. They're actually funding plaintiff law firms now and drawing out lawsuits that would have been settled for less previously. There are certainly jurisdictions where you're having much larger claims and where it's easier to bring suit, and you're seeing an increase in insurance casualty rates in those jurisdictions. They're quaintly known as judicial hellholes, which I don't know. It's not the term I would necessarily have used to name it, but it is a thing that's out there. And then just these big ticket claims that you might have read about in the trade press, that has a chilling effect on the casualty market. So one example that happened in Texas a couple of years ago, most folks have probably heard of Greystar, one of the largest, if not the largest, manager and owner of multifamily housing. They had a significant construction accident at a site in Texas a couple of years ago. It was a big crane that fell over. There was, unfortunately and tragically for the crane operator and their family, the crane operator was in the crane when it fell over and tragically passed away. And I don't want to minimize the impact, emotional and otherwise, on that man's family for that tragic accident. But I want to just articulate what that translated to in terms of a jury award, and that was $800 million. And when you have awards like that on work sites that are similar to the type of work that we do in jurisdictions that we may or may not work in, that has an effect that gets baked into the market. So here's my little handy slide on the judicial hellhole. This isn't a map that I created. This is from the American Tort Reform Association, and obviously they have a political bent in what they define as a tort hellhole. But if you happen to be doing markets, thankfully Vermont's not on that list, and I'm glad for everybody's benefit. But if you happen to be doing work in these particular markets, you may be seeing higher casualty policy costs as a result. So what I'm describing isn't just our anecdotal experience. It's been proven out by industry survey data as well. So National Leased Housing Association, in partnership with the National Multi-Housing Council, last year did a survey of over 2.8 million affordable housing units across the country. And what you can see here is the trending in the premium increases. And what I just want to highlight here is that in 2022 and 2023, you have here essentially 75% of all affordable housing that was captured in the survey, and it's a pretty big sample, experienced a 10% or more increase in their premiums. That's self-reported. And 29% experienced a 25% increase. I think this is actually an underreport, and I think that's a factor of who was surveyed and the markets that they were in. I certainly know many people, including ourselves, that experienced a much harder renewal cycle. And I don't know, it gets into like the methodology of the survey, but depending on when your renewal is, like some people that were captured in the survey had better 2022 data and had really rough 2023s that just weren't captured because of the timing of the survey. And what's interesting about this chart is just other data points from the survey. Essentially, these are strategies that our peers are all implementing right now to try to address the rising premium increase. You may have lower premium increases but higher deductibles, which is taking on more risk. You may be deferring operating expenses, increasing rent, and more on that in a minute. Postponing, investments and O&M type of work, and just reducing coverage in general. None of those are good dynamics for the industry. And none of those are sort of structural solutions to the problem we're all facing. More fun data here. I'm forgetting who's the source of this insurance data. I want to say it's Marsh. We've had 25 straight quarters where insurance premiums have increased for property. So this goes long before COVID and the ramp up that came around with that. And a similar experience, although not quite as dramatic, on the casualty side as well, although I think that what we're going to see is that's ticking up. And in spite of all of these insurance increases, we haven't seen operating revenue increase in line with it. So I just wanted to flag here what OCAFs have done over the last 5 years. So we were having these 25, 22, 28% increases in premiums on a quarterly basis in 2019, 2020, 2021. We were seeing OCAFs only going up for Section 8 properties, 2.2, 2.53%. In 2023, to HUD's credit, they actually changed the OCAF methodology and started using more accurate insurance data. So instead of using CPI insurance data, they started using producer price index insurance data, which resulted in the jump in OCAF in 2023 and 2024. I just also wanted to show kind of, and actually my next couple of slides are all about inflation, but you can see the correlation between insurance premium increases and inflation and sort of that interplay there. We know we have an inflation problem. This was actually from Bureau of Labor Statistics. You may have seen this in the Biden administration's recent housing report. I pulled a couple of great slides from that. If you look and you see what is driving inflation today, that kind of light blue line here, I don't know if my arrow, you can see it here. Housing cost is actually one of the biggest drivers on why inflation is still as stubbornly high as it is today. And you look and see, well, what's driving, housing cost inflation? It's operating expenses, and this is just another view of it. You can see core inflation, this red line, for the most part is going down, other than shelter or housing costs again, which is keeping it up. Well, what's driving that inflation and housing costs? It's higher operating expenses, driven not exclusively by, but in large part by higher insurance costs. And then just a kind of housing affordability data set here. You can see that wage growth is not keeping up with housing costs. So this is having, as we all know this as affordable housing professionals, this is increasing our challenges in terms of housing affordability in the country and making housing generally less affordable. So last slide before I hand it over to the next part of the discussion, but I just wanted to put a point on not just why the insurance problem is remaining stubborn and challenging, but what it really means to us as affordable housing professionals. It is absolutely the case that rising insurance costs are having a negative impact on housing affordability. When you see market rents increasing around the country, obviously, as operating expenses increase in the non-subsidized space, those get passed on through to the resident. We experience that on commercial leases as well. And that increase in housing costs is driving inflation, and that's actually affecting us in the affordable space as well. As we have increased operating costs, that has an absolute negative effect on our transactional costs. So when we're underwriting our new loans and our equity, we got to service that debt, and when our operating expenses go up, our debt proceeds go down. And just the unpredictability of insurance, and also throw in builder's risk, which I don't talk about in my slides, and I'm not sure if others will talk about in their discussion. The cost of that has become so unpredictable right now that you get to the closing table and you underwrote one expense, and then you get the quote and it's something very significant. That delays closings, which increases costs. You rebid your project after if it takes an extra 3 months to fill the gap, and then your other costs go up. That's having a real effect on production. On our existing portfolio, it's having a real negative effect too. Obviously, we're seeing declining revenue where we've been underwriting growing revenue, and it's largely, again, rising insurance costs. And it's forcing us as affordable housing practitioners to make bad decisions, or maybe bad decisions aren't the right word, make decisions that we don't want to have to make, tough decisions because we're out of options. Of course, we have to pay our debt service, we have to pay our property taxes, we have to pay our staff. There's all of these things that we have to do, and if there's less money as a result of unexpected increased operating expenses, that forces us into these false choices of, do we defer maintenance? Do we reduce the services at the property? I run the resident service programming at Lincoln Avenue, and that's not something that I want to do. But it's another couple of years of this, and it's going to start looking a lot more challenging. You have to maintain insurance requirements as part of your debt and equity covenants. And while I haven't experienced this, certainly at Lincoln Avenue, and I haven't talked to folks that are experiencing this yet, because lenders have been supportive and giving us waivers and the like, if we're not able to maintain our insurance requirements, that's a technical default. And that's a foreclosable event in some situations. And if we don't resolve this in the long term, there could even be a foreclosure crisis as a result of this. That's not strictly because of financial default, but just because of those types of requirements. And I think in the long term, more and more owners that are otherwise mission oriented and want to do the right thing, if they're not able to operate their businesses, in the black, some of them will consider opting out or selling properties at the end of their, year 15 or year 30 to owners that may opt out. And that's not a great outcome either. So I know it's a lot of doom and gloom, and I threw a lot of numbers out there, but from a high level anyway, I think that's a lot of what's driving the market today, and a lot of the consequences to our industry if we don't wrap our heads around a solution. And with that, I think I will hand this over to the next presenter.
Thank you, Tom. Hi, everyone. Thank you so much for letting me be here today to talk about this really important subject around our insurance industry. Tom just gave a terrific overview of what's happening at the national level with insurance. My goal today is to provide a little regional data so you can have a better sense of what's happening at the regional level. So my name is Sharon Vale. I'm the Vice President of Asset Management and Portfolio Initiatives for Evernorth. And I am going to present our portfolio insurance review from our footprint, which is in Maine, New Hampshire, and Vermont. So I'm going to share my screen. Okay, and I think I need to change the view. Forgive me, just a moment. Sorry, guys. We actually tested this before, and I'm just not seeing. Let me try one other thing. If I could, I'm gonna start from the beginning and display settings. Okay.
Having seen Sharon's data, I can say, I can vouch that it's worth the wait, because if she pulls it up,
Thank you, Maura.
it's an excellent survey that they did to get information across the three states.
Okay. Can you see my screen now?
That's perfect. Yep.
Okay. And I'm here. There we go. All right. So thanks for
Sorry,
your
Sharon,
patience,
I'm gonna
guys.
interrupt. You'll want to go back to that display settings. You had it right, but
Oh, I did.
top choice.
Okay.
Yep. Thank you. Perfect.
Great. Thank you for the technical support, Maura. All right, here we are. 2024 portfolio insurance review. Again, this data represents 3 states, Maine, New Hampshire, and Vermont. Evernorth is the syndicator for properties in this footprint. We're also a real estate owned of our assets in Vermont. This data sampling represents 277 properties, about 10,000 units. What we collected and we're going to present today is a 4-year premium cost per unit trend from 2020 to 2023, and also the 2024 premium cost per unit that's budgeted. We also captured the property coverage amounts, the liability coverage amounts, property deductibles, brokers, insurers, from a geographical perspective, by state, by county, and by municipality, and also by general partner and by property management company. From a data integrity perspective, I do just want to mention that once we extracted all of this financial information, we really reviewed it to identify, any numbers that looked kind of wonky, that were outliers, excessively high or excessively low, that did make a lot of sense. There was a small percentage of those, and what I found was those fell into kind of 3 buckets. Some insurance premiums were commingled with condo association fees. Some were a bit skewed because they included mortgage insurance, so those were corrected. And some properties that were, newly constructed within this 4-year span, that first year of their premium effective at permanent loan closing typically was prorated. So those were all extracted. So we feel good about the data integrity here. That being said, the 2023 numbers are unaudited just due to the timing of the presentation. So the first slide here, again, outlines 277 properties as part of this review and 9,855 units. The table at the top middle here shows your average cost per unit, starting with 2020. At $471 per unit per year. You can clearly see a slow increase in per unit costs to $502, $541, $610, and in 2024, the average at $689 per unit. That represents about a 46% jump in 5 years. One other thing I want to add to that is the 2023 coverage costs per unit, while the average is $689, that range was as low as $206 a unit and as high as $1,680. The average property coverage, what we found was about 8.7 million. The average liability limit was 6 million. And the average property deductibles, it ranged from 1,000 to 250,000 deductible, where the average from a numeric perspective was 10,000. So the next slides focus really on the premium trending and analysis. I liked Tom's slide earlier that had this format, so I wanted to provide some type of regional perspective that aligned with what he presented from a national lens. But here, from a premium increase, the year starts at 2020 at the bottom, and then you can see the changes moving up. Light blue is the percentage of properties that received a premium increase of 10% or less. So from this graph, that's a good majority, and that's the good news. The dark blue gets into that 10 to 15% increase range. That's when we all start to feel uncomfortable. Then you have your 15 to 20% increase, and then 20 to 25% increase. 25% or more increase is in the pink color-coded area. I think what is probably obvious to most of us here is that the percentage of properties that received a 25% increase or more has grown year over year. In 2020, 2021, it was at 6%. And now current time, 23 to 24, 22% of the properties are seeing that level of increase. A little caveat to add, however, in focusing on those properties that are receiving 25% increase or more, 48% or almost half of them, their premiums do remain kind of below the average of 610 per unit in the portfolio. So while their increase was excessive, the premium itself, about 50% of these remained somewhat reasonable. But then 29% of those premiums that saw that increase were at the higher end, 642 to 846 per unit. And then 23% that received that level of increase was at the high end of 1,002 to 1,045 per unit, which is really unsustainable. One food for thought with this graph, I think this kind of helps as we looking at how do we project the next 5 years. If you're looking strictly from a data perspective, you have a better sense on where your insurance costs are going to be. But I think the other component that can be helpful in looking at this as we're underwriting deals under development now, I think whatever the cost is today, given we have an 18 to 24 month window of construction and leasing, that it's fair to say once that project starts to operate, you can expect the insurance cost to be 20% higher. The next slide goes over insurance coverage type comparison. So the 3 buckets of insurance coverage type, one is your traditional, 1 policy per property or 1 policy per blanket property coverage. That's in kind of the light green bar graphs. The dark green is the captive program that Michael will tell you more about later in the presentation. And the lime green is for self-insured premiums. What this graph shows, I think, is that the captive premiums have been lower historically than the traditional, although that gap closed a little bit in 2024. The self-insured premium is excessively low and very attractive. But before you get too excited about that, just wait till I get to the deductible slide and you'll see the deductible that's paired with. That tells the bigger story. I also looked at per unit average by construction type. So we have 2 types. We have new and rehab. New is new construction. Rehab encompasses rehabilitation, ACC rehab, of course, historic rehab, and any adaptive reuse properties. And the data shows us that rehab properties have a 7% higher property premium cost on average. Per unit average premiums per state. I broke out the premiums between Maine, New Hampshire, and Vermont. Maine is in light blue, New Hampshire, the dark blue graph, and Vermont is in orange. Clearly, the premiums are very, very consistent across all states. There aren't any significant outliers from a state perspective. And they do kind of follow the same linear line from a trending. New Hampshire's in the dark blue is slightly more in premium per year, with Vermont closely behind and then Maine behind there. But really, they're very comparable. I also just extracted the highest premiums by county just to determine if geography really is a strong driver, and if so, the reasons behind that. What this shows you is the 5 top counties. They're interestingly enough spread out across all 3 states. So it's not a concentrated high-risk area across Maine, New Hampshire, and Vermont. Hillsborough, New Hampshire was a pretty big sampling of 609 units. The average is 771 per unit, which is certainly higher than the 610 average. But what I wanted to share is Hillsborough is a high-risk flood zone. They do have properties at the low end of the scale, 338 per unit, but also as high as 1670 per unit. We are aware of one lawsuit and also a casualty event that resulted in a claim within this concentration. Knox, Maine is just 2 properties actually, but Knox is also in a high-risk flood zone. And the average of those 2 is on the very excessive end from our portfolio data. Lamoille, Vermont represents 8 properties. The average is 717, but again, we saw very large ranges as low as the 2 on the high end are 1,022 and 1,500. Oxford, Maine is just, 1 property, not a great sampling, but that 1 property came in high at 817 per unit. In Washington, Vermont, a good sampling size of 310 units. We also saw a large range, around 400 per unit up to around 1,200 per unit. I'm sure as most know, Greater Montpelier is part of the county of Washington with a very high flood history and flood risk. And next is per unit per deductible. Wondering if there was really a correlation between lower deductible, higher the premium, or what have you. So this slide is interesting. The first bar graph is $1,000 deductibles. They averaged a premium of $758. You do increase your deductible a little bit and lower your premium. So at the $2,500 deductible amount, your premium goes down to $667. And then the $3,000 deductible at $526 per unit premium is kind of the sweet spot. But really, there's not a great difference in premium between $3,000 deductible, $5,000, $10,000, and $25,000 deductible. This big outlier here is represents 1 property that is has $100,000 deductible, and its premium is also high at $1,018. I can talk a little bit about that in our next slide, which goes into the deductible. But that owner has properties throughout the country, and many are in those high-risk areas that Tom talked about earlier. Therefore, it's kind of a collective. And a point of reference, in those higher risk areas, Tom probably is more versed in this than me, but my understanding is $100,000 deductible is common in more high risk areas nationally. So for them, that kind of makes sense. But when you compare it to our kind of Northern New England portfolio, it really is striking. And then the last deductible is that $250,000 deductible, and that is the 1 self-insured property. So just a snapshot of what we're seeing for the property deductibles across the portfolio. The majority of the properties here in this purple are at the $5,000 deductible. That seems to be the most prevalent. Behind that is the $25,000 deductible. That's about 24% of the portfolio. And then we have the $10,000 deductible is about 17% of the portfolio. And the $2,500 is also about 16%. $1,000 deductible, very few. And then we have the slivers at the $100,000 and $250,000 rate are represented. These numbers are by units for your perspective. And I wanted to add, I think, Tom talked a little bit about, the limited partnership agreements and insurance requirements, and if they are breach, that could be considered a default, and that's very significant. The LPAs in the Evernorth portfolio also have insurance requirements. I found the language around deductibles to be variable. Every LPA is different. Some don't have a maximum deductible included in the insurance requirements, and some do have the maximum allowable deductible at 10,000. So always worth looking at your individual LPAs. And if it was over the allowable deductible, the limited partner consent would be needed contractually. I did talk about that $100,000 deductible and why it was at that level, similar to the one property that's self-insured at $250,000 deductible. Just a snapshot of coverages by broker, so you can get a sense of the market share for the portfolio in Maine, New Hampshire, and Vermont. Each state has at least a dozen brokers they work with, which is great. Maine has 15, Vermont has 12, and New Hampshire has 17 active brokers. From a market share perspective, Clark Insurance has the highest percentage of properties they are brokers for at 20%. Behind that, pretty strong is Hickok and Boardman at 14%. And then IMA, Dennis Wicker and Brown, and NFP wrap out the market share. And then coverages per insurer. Vermont Mutual has the largest market share at 33.94%. And then a distant second, Philadelphia Insurance at 19.5%. And then James River, Lexington, and Great American wrap out our market share from an insurance perspective. We have the majority of properties have one insurer. About 95 have 2 to 5 insurers, so not terribly uncommon to have multiple insurers, which spread the risk. A few have 6 to 10 insurers for their one policy. And there is one property that has actually 11 insurers. And in speaking with that general partner, they explained that their policy is about 11.3 million. And they had to align one insurer for every $1 million allotment. So one insurer for 0 to 1 million exposure, the next insurer for 1 to 2, etc. That was an interesting model I haven't seen, and I don't know if that's going to become more common in our area, but just wanted to share that. And the last slide here is just a little bit about the financial impact. So if we were looking at this insurance trends and obviously being alarmed at the increased premiums and the larger deductible exposure, it would be one conversation if our properties could absorb those costs. But that's really not the case. Most of these properties are underwritten quite tightly, and Tom referenced so many of the inflationary aspects that are causing operations to be leaner and harder. It's not just insurance increases that are causing operational struggles. So we know it's staff wages, it's maintenance costs, it's material costs. The list goes on. It's that perfect storm. But what does it mean for the Evernorth portfolio? So in 2023, 25.99% of our properties ended the year in a deficit. We looked at, of those properties, which ones are getting an insurance increase, and would that impact their ability to operate or go from a surplus into a deficit. And just we can say, based on the data, the deficit positions will increase to 30.32% in 2024, given the impact of the insurance increases. And the average insurance premium increase for 2024 was 15%. So that kind of tells that full story. So that concludes my presentation. I will stop sharing. And I believe I'm going to turn this over to Michael Monty. Thank you.
There we go. Can you hear me okay? And can you see the presentation? Okay. Thumbs up. Excellent. Thank you. So I am Michael Monty. I'm the CEO of Champlain Housing Trust. I know many of you here. Some of you I don't, but you might not know that I'm also have been a member of a captive insurance agency domiciled in the state of Vermont, which insures properties throughout the state of Vermont. I am served on that board for about 12 years, and I've served the last 2 years as chair. I actually know more about insurance than I would care to. But at the same time, the insurance company that we're sort of operating throughout the country has some policies and practices that I think might be valuable to all of you. So I'm going to share quickly who the company is, and then I'm going to go quickly to some of the things that we do. So again, we serve, this is a captive insurance domiciled in the state. It meets here every year on a regular basis. But we have meetings, of course, by Zoom, and we operate throughout the country. Here are some of the members. Here are some of the states, including California and Florida and Texas, which is some of the more difficult states, shall we say, in the portfolio, but throughout the Northeast. Again, overall, 24 members, a unit count of about 100,000, premium value is 36 million, insuring $22 billion worth of assets. A fairly decent sized company has been operating since 2004. I could say 5 years ago, we actually got a return in terms of our investment. 4 years ago, we had no increase, and then things have gone downhill since. More difficult each year, as the two previous speakers spoke to, all those reasons, both climate and sort of performance overall. Here are the program goals and principles, and it's interesting that the first little column here is about ownership and oversight, reduce and stabilize premium, stability, accountability of ownership, you know what's going on, superior claim management, all that stuff. But the second column is all about loss control. And really, that's where it's at for us. Specialized loss control service, robust member engagement, peer exchange, commitment to loss control across the portfolio. And really, that is the conversation that we have almost all the time. There's not much we're going to be able to do right now about climate and sort of the impacts it's having amongst our properties. But one of the things we can do is mitigate losses. That helps us even in terms of the deductible. And so that particular work and effort that we do as an organization, as a captive, is critical. I have 2 staff people here at CHT who basically go to a loss summit every year in Denver, and they share information, make presentations, and do peer exchange. Here's some of the things that we do in terms of initiatives. Each of our properties has a liability and risk score. We do a loss prevention committee, which talks about site security, lithium battery best practices, water detection technology. Water is the biggest issue. Fire is the other biggest issue. In terms of if we're not beyond climate, those are the 2 things that impact our properties the most. So at the risk control summits, they talk about those kinds of things, including things to write contractually into our work to make sure that we transfer as much of the risk to others as possible. Tenant education, enhanced service plans. Those are the kinds of things we're sort of engaged with and all the members. And we're working. I'm going quickly here so we can get to the end for other people to speak. Here's some excerpts from the enhanced service plan. This is a fairly lengthy sort of document, which we're all sort of tested on internally, where we look at a range of issues in terms of emergency response and life safety. Again, fire protection. You see lithium powered bikes and scooters as being an issue, stovetop, fire suppression as being important. All of these things are things that go through. We have a worksheet that we've gone through. We have gone through the enhanced service plan to make sure that all of our properties and our procedures are meeting these kinds of things. I'll go to one particular item. that is so exciting, lithium ion batteries. They're being outlawed, I think, internally to be in New York City in terms of people's ability to keep lithium ion batteries in apartments. We don't allow them now in our apartments. It's principally you can, these are the best practices. If you, this, not all members have outlawed them, but if you see there are some best practices that you could provide education to tenants in terms of keeping lithium ion batteries. Again, the principal ones have been the e-bikes, and they have created havoc in properties all across the country. And these are some of the things that are recommended. So this is the kind of stuff, this is just one example of the kinds of information that gets transferred and gets shared and gets exchanged amongst members of the exchange. And I think that's it. I tried to go as quickly as possible. I can go back to any of these other things at any other time, but I want to pass it back down to now Andrew, I think. Yeah. Oh, no, excuse me. Back to Tom. Sorry, let me stop sharing.
I want to recognize, while Tom pulls up his slides, I want to just recognize that I see that we have David Shore here from Congresswoman Balint's office, and I'm scrolling. There may be others from Senator Sanders and Senator Welch's offices, but this is the time that our federal partners and our DFR partners who are on the call will want to listen in, because I think Tom's going to take us through some of the conversations about what's the advocacy we could actually do to change some of these dynamics.
All right. I think I'm unmuted again. So just a little bit of inspirational quote from the Colonel here. But I think why I have this quote up here is that we've been doing a lot of waiting and seeing and hoping that the problem will solve itself. And I think that my philosophy anyway is that waiting has not solved the problem. The underlying issues that are challenging us in the market that we saw illustrated in the previous presentations exist, and so we need to take more concerted action as an industry and as a country. There are a lot of different solutions that we can and I think should at least explore. And I'm going to start with legislative solutions, but I think that there are actually lots of things that we can do at congressional level, at a Biden administration level, and that the state legislatures as well as state housing finance agencies can do to help facilitate better solutions. So the big ask, the big structural intervention would be some sort of federal backstop. I think this is probably what's necessary, barring a solution to climate change, to address the major cat issues. There is a long history, in fact, as well, of the federal government intervening in insurance markets, and I've got a bunch of examples here on the slide. But most notably, and the example that I think is most attractive to me, is the Terrorism Risk Insurance Act. So just as a reminder for folks that aren't familiar with TRIA, after 9/11 became difficult to impossible to procure terrorism insurance in a lot of major markets. And this was required coverage, and so we had a real sort of crisis on our hands, and Congress intervened and created TRIA. What's sort of attractive about this approach, I think, politically and philosophically, is that it's administered by the insurance industry. So it's offered by your traditional broker network, and it's kind of a counter-cyclical product as well. So it took some time for the insurance industry to figure out how to underwrite terrorism risk, and today, while you can still buy TRIA insurance, most of us don't, because the private market has come back, but it's available there and an option. The National Flood Insurance Program is obviously something that a lot of us are familiar with and may already be buying flood insurance through. Long history there. A lot of struggles with that program too, so I'm not sure it's the best precedent, but it is a precedent. And I'll get to this more on a future slide, but We insure housing in a variety of ways as well, through the GSEs, through FHA, through USDA, and even single-family mortgages through the VA as well. And there's probably a bunch of different ways in which we could take these housing insurance products and create an insurance wrap. Crop insurance is another example. Many of us live in markets where the single-family insurance market is not super functional, and the federal government intervened in conjunction with the fair housing laws in the late 60s to create the Fair Access and Insurance Requirements plans, the FAIR plans. This is kind of the insurer of last resort in a lot of places, and I believe today in Florida, 50% of all homeowner policies are actually purchased through the state's FAIR plan. It's not an ideal situation, but I'll just point out that there's not a FAIR plan option for multifamily and most types of our coverages in most markets. So expanding or access to the FAIR plans might be another strategy. There are global precedents of federal backstops in other markets, so Germany, France, Italy, Spain. There've been, and actually I'll get on the next slide, there's actually a measure that Representative Adam Schiff has introduced to create a product like this. In addition to a federal backstop, which is in a lot of ways a heavy lift politically, although something I think we need to keep our eye on the prize for, tort reform and premise liability reform would be impactful on our growing casualty policies. We can certainly do things to try to draw capital back into the marketplace, insurance capital, I mean. So this could be done through tax incentives, by creating tax incentives for reinsurance companies to domicile here and potentially be covered more by our regulatory structures. If you look and see who the top reinsurers are globally, most of them are not U.S. corporations. Berkshire is a large one, but then you look down the list and it's a lot of British, Central European, and Southeast Asian organizations that are providing reinsurance. And they don't have, obviously, the same accountability structures that a US-based corporation would have. Of course, we could also do direct subsidies and appropriations and price supports as well. Just a little bit, I mentioned Mr. Schiff's bill, the Insure Act. It really, the concept on this bill, it's been introduced, it's got some co-sponsors, but it hasn't moved, and just based on what our industry partners are suggesting, there's probably not a vehicle for it to move this year. But it would create a federal reinsurance program out of the Treasury Department that would cover the major cat risks. It would require participating insurers to write policies for those cat risks, so it would deepen the pool, presumably. There's a data component to it as well. And there's also significant, it calls for significant appropriations for loss prevention and risk mitigation, climate and otherwise, on the order of, I think, like $50 to $70 billion a year in appropriation. So I think there are a lot of things as a marker that are really exciting about this, that it's getting the attention, that there is a bill, and that conceptually there are parts of it that I think would be effective. It's probably a little politically difficult right now, just given the environment. There are things about the bill that would probably be not attractive from a bipartisan basis, although I think it's well worth additional discussion, and glad to hear that there are representatives from our congressional and senatorial offices on the call. I think it would be great for you to explore these types of solutions further. It would be great, in fact, for there to be more coverage, particularly in the Senate Banking Committee and the House Financial Services Committee, on insurance as issues, and in particular its effect on affordable housing, which has gotten some coverage, but in my feeling, not quite enough. Beyond congressional action, there's lots of things that the administration can do and is exploring right now also. So the income limits just came out today, or yesterday, I guess. And the policy around the caps on income limits, we would encourage the administration to continue to explore how to make sure that inflationary costs like insurance are being captured appropriately in income limits, so that as our expenses grow, the burden of those expenses are shared appropriately across all the major stakeholders. Way back on 5 slides ago, I showed you the OCAFs and how those increased when HUD started using PPI data, but we had several years of artificially low OCAFs that didn't actually capture the insurance costs in the market. I know it's an appropriations challenge, but we'd love to see the next round of OCAFs essentially true up and capture what should have been captured when they were using the wrong data set. For Maura and her HFA colleagues, just to continue to consider insurance costs and how they're underwritten, in your allocation policies, and to drive, to the extent possible, more tax credits into deals to offset the rising operating costs, I think is an important strategy to consider. So this may be around what you include in an eligible basis or not, but I think that there's some more things to examine there. To the extent that there are federal grants that haven't been appropriated yet that overlay with either operating costs or infrastructure upgrades around resiliency, and I flagged kind of the ARPA and state and local fiscal recovery funds and CDBG and some FEMA programs, to reprioritize and direct them to efforts that will make our portfolios more loss resistant and resilient, would be a good use of our dollars, and would ideally help us lower our operating costs, or de-risk our portfolios and lower our premiums over time. To the extent that there's fair housing discrimination that is happening around insurance, source of income, and otherwise, I think HUD is actively exploring this right now. Data will also make our case better, and there are a variety of data initiatives underway. The Federal Insurance Office is attempting to collect data. The National Association of Insurance Commissioners is pursuing a more robust insurance data collection process to help drive more policy at the state level. Unfortunately, so far it's single family oriented, but wrapping multifamily into that would be great as well. And I'll just put in a plug for an initiative that I'm involved in. Many of our industry partners are actually creating an insurance operating cost clearinghouse, and it's sponsored by Fairview Housing Partners, which, full disclosure, is a nonprofit that I serve as executive director of, to collect this operating cost line item data to help us as advocates make the case to our state and federal stakeholders that we need different solutions. On the GSE front, there was actually, and Sharon attended this, there was a great symposium hosted by the Federal Housing Finance Agency just a couple of weeks ago in DC, brought together a lot of stakeholders, as well as Fannie Mae and Freddie Mac executives, to explore market and policy solutions that the GSEs and FHFA can facilitate. And I think that there are a number of things that those agencies can do, at least to help us acquire more affordable insurance. So revisiting minimum insurance requirements, particularly around deductibles, but also being able to effectively leverage captives like Michael spoke about. Agency lender requirements sometimes need to change in order to actually facilitate that. The valuation methodologies we use to better incorporate modeling and to use more appropriate total insurable values will help buy down our costs as well. And I'm strongly advocating for the GSEs actually stepping in and seeing what they can do to actually either facilitate a backstop directly or indirectly through the use of community-based catastrophe insurance, which is, for lack of a quick explanation, a captive-like structure to share risk and subsidize difficult to insure projects, or even adapting their current loan products, particularly I think the green products, to incorporate resiliency. If we can design our projects better and make them more storm or fire or quake resistant, we will get lower premiums over time, or at least a decrease in the increase over time. And I think that there are creative ways in which Fannie or Freddie, or ideally both, could take those existing products, update the term sheets, and encourage more resiliency. I mentioned judicial hellholes earlier. This is the same map again. There are local premise liability reform efforts underway right now. So the state of Georgia in particular, which I think is on here, the governor is proposing a pretty significant tort reform package in the legislature right now that would be very helpful for owners there. Florida actually used to be on this list until they passed a major insurance reform package last year, which has been really significant on casualty renewal policies. This is just kind of more of the same, but in addition to tort reform, premise liability reform, community-based catastrophe insurance, I mentioned FAIR plans earlier. I think expanding access to affordable housing stakeholders here could be significant. I think that there are certainly things that we can do around the excess and surplus markets as well, which doesn't exactly jive with the stat that Sharon provided, but I will share that it's our experience and a lot of our larger peers' experience that we're not buying covered market policies directly from insurers. We're cobbling together policies that may have 25 or 30 different layers of insurance with different providers into a master policy, and that's being put together through the excess and surplus market, which doesn't have the same rate increase restrictions that the state covered markets have, and I think that's one of the many things that's driving some of the premium growth as well. And there are a lot of industry efforts underway at the major trade groups organizing around this. So the Tax Credit Coalition has a very active insurance working group that I'm part of. National Association of Home Builders at their fall meetings passed a resolution to make this one of their top issues. You've seen some of the National Leased Housing and National Multi-Housing Council data that exists already. The Housing Affordability Coalition, which is an umbrella group that includes a lot of the associations that are on this slide, as well as others, has a task force on this. Bipartisan Policy Center is hosting a symposium in June addressing housing affordability and insurance, or at least in part. So there's a lot of different ways for stakeholders to get involved in their trade groups to advocate for some of these policy solutions too. And this is my joke question slide, which I will take down so we can actually get to our questions.
Hey, thank you so much, and thank you, Sharon and Michael, for a really excellent overview, not only of local issues, but federal issues. So I'll ask one question, and then I'll open it up for questions. So be thinking about what you'd like to ask. You know, I'll rely on Maura to help spot hands, but if you can use the hand feature, raise your hand. We'll get to you as we go through. 45 minutes for questions. Hopefully that's enough time. I'll ask a quick question. Michael, you talked about lithium batteries as an area. Maybe you've had a loss related to lithium batteries. Maybe not, but you went through a couple of other loss prevention measures that you could take fairly quickly. But are there other ones that stand out for you, or things that you're doing as you look to try to prevent loss?
I think the two issues that have caused damage in properties and across the portfolio of Hypex have been water and fire. Those are the two. So anything that can be done to sort of prevent water intrusion as it occurs. So we have some detection systems now in some of our properties that are picking that up quickly. And anything that is going to stop fire. We've had 2 stove fires last year. done because we had these little suppression systems over the stove, which I think is common now. If you don't have those, you should be getting those. But those kinds of systems, those kinds of education, property managers knowing what to be looking for when they're going through properties, maintenance people knowing what to look for when they're going through properties is the way to sort of stop it. We had a major fire, which had to do with a barbecue, a gas stove on a porch. That shouldn't have been there. If that had been off-site or off the property, we would have basically saved ourselves quite a bit of a bang on our system. Hypex evaluates each member for its losses, and so internally we sort of are going through the process of always seeing what we should be doing. But those are the two really, and we could probably there's probably more a half a dozen other things that Luther is here, who is our insurance lead with Hypex in terms of like managing the portfolio. He could probably add a few more things in the chat if I can encourage him to do that. But certainly be willing to share more of that as we sort of have more conversations around the state.
Great, thanks, Michael. I see some hands coming up. Thanks to
Andrew, can I add something to what Michael shared as well? So in terms of loss prevention, one, your broker, if you ask him to, will walk through operation and maintenance best practices that are effective. Most of them offer that as a free service, and there's a lot that you can do from your snow removal policy to your security cameras and things of that nature that are effective in reducing claims. And there are also building standards that are increasingly focused on resiliency. So we actually partnered with Enterprise a couple years ago to do a full resiliency analysis of our Florida portfolio through their Keep Safe Florida program. I don't think it's still up and running, but the resource they did was like a desktop analysis and checklist that you could have a maintenance person walk through, and it identified all sorts of, for the most part, low-cost improvements that we could do that would be helpful from a building resiliency perspective. So things like moving the air handlers off the ground if you're in a flood-prone area is a way to save those systems. And then the fortified building standard is something that I think is getting a lot of attention, particularly in the Southeast. When Michael mentioned water and fire, one of the big issues that you have with high wind is when your roof blows off and the water blows in. If you can really tighten and anchor those roofs appropriately, and the fortified standards is a good way to do this, you can prevent a lot of that water intrusion and make instead of just having a roof claim, or have just a roof claim instead of having a roof and full interior claim. And that's that can be really significant. And that's available for multifamily, and there's even a fire version of it for single family that translates well if you're in a wildfire area.
Great, thanks, Tom. That's an excellent additional place to look, the fortified standard. Okay, so I'm seeing some hands up. Rural Edge. Go ahead. I think I recognize you first.
Hi, Becky Mashore, Rural Edge. Beyond policy increases, we've hit a snag this past year with our carrier actually requiring physical expenses to the project that above and beyond what code requires. And I'm curious if anyone else is experiencing this. We finished a project completely and then got told by the insurance company that they wouldn't cover the building because there wasn't a second form of egress for the third floor apartment, even though by code we'd done everything necessary, including sprinklers and whatnot. So we, at the end of the project, experienced a project overage because we had to add a second stair egress. And so now that we try to look at this in all of our new projects where there's a third story, we're really running into problems such as where do you put it on a historic building? Where do you put it on a lot where the setbacks don't allow it? And what's our flexibility? I mean, how do we flex our muscles to push back on the insurance company when we're limited to so few in the state that are covering these types of properties?
Thanks for the question. One of the panelists want to jump in on that one?
I don't know that we've experienced that specific fact pattern, but I will say that in terms of getting builders risk policies, for example, there are absolute like security requirements that we have to have now that we didn't used to have. And we've tried to get really creative around, site security in particular, and remote monitoring and cameras, and what the economic impact is on the builder's risk policy based on different systems. And we found that we've been able to align some systems in such a way that the cost of the system is, versus the impact on the builder's risk policy, where it's a net positive for the deal. So it's about, getting creative. And but yeah, literally everything in our design process now, like we're asking, how does this affect our future insurance policies? And we're designing properties around that now, and have an internal tool we've developed specifically for that at the site evaluation phase.
That's great. Really, sounds like a good additional step that folks can be taking as a way to try to head off surprises at the end. Okay, M&S Development. See your hand.
Yeah, thanks. So I'm Sky Morse, M&S Development. I have a couple questions. We've had a few claims on our properties in the past year, and we've actually seen like a threefold increase in our premium, which is potentially, jeopardizes financial viability. So this is something that's really, we're really paying attention right now. I'm curious, Michael, is CHT involved in the captive that you described? And is that open to new members? And along with that, would there be appetite or interest amongst the other developers? I mean, I think I see almost every one of the housing trusts and other interested housing folks in the state here. Would there be interest in trying to stand up our own captive to serve the housing properties in the state? And we'd have to see if that would actually make financial sense.
Okay.
I'll let the answer is yes. The captive basically is a cooperative. All members of the captive own the captive itself. We own different shares depending upon portfolio and our premium. So we are owners of the captive. When we joined the insurance company, essentially we joined a participation in the captive. It is not open to almost anybody. You have to be a housing partnership network member. However, it continues to sort of understand and look at the insurance issue on a broader scale, and has begun to think about what else it could be doing in order to, as Tom would say, increase the availability of insurance. But I think the idea of a Vermont captive is an interesting one. I would be cautious about it, because really there is a certain number you want to get to in order to ensure that the risk is shared. Just like you don't build 10 units of housing and have 2 vacant and the whole property goes down, you want to have a critical mass. So that becomes really the principal issue before you form a captive.
There's capitalization issues too. So you have to fund, at the upfront, a pretty significant reserve, and you capture the savings ideally later. But I'll just say from an industry observation perspective, I'm aware of at least 2 other group captives that are or 3 now actually, that are in the process of soliciting members and considering formation. They're not housing trusts. The groups that I'm aware of are sort of larger private developers in other jurisdictions, but it's certainly a strategy that other smart people in the industry are pursuing, and it's an internal strategy that we're looking at also from our own perspective, a kind of hybrid version.
Well, I see that Kevin has his hand up, and for those of you who don't know Kevin, he's involved with HAI Group, another Vermont-based captive insurance company. I think you serve on the board, if I'm correct, Kevin. For those of you following along home on the chat, there's some good comments there and some good connections. Kevin, you want to talk a little bit about that?
Well, I think that philosophically, HAI Group is probably very similar to Housing Partnership Insurance Exchange. It is a very large organization that originally focused on public housing, but as public housing increasingly privatized, it's now public and affordable housing. And I did provide a website link in the chat feature. I know that I have a possible program coming to the state that would address educationally some of the same things that we've talked about about the market for multifamily, and obviously the challenges and some of the potential solutions. So yes, I'm glad you did mention the fact that I am on their board of directors, and in the interest of full disclosure, that's an important point to be made. But beyond that, I've been with them for about 25 years, and I've had nothing but a good experience. They have a focus on risk reduction, risk control, and consistently I've received premium refunds on an annual basis based on the company's performance. So I'll stop. I don't get any reimbursement for my comments and supporting HAI Group. They are sincere, and if folks are interested, the link is there. If people want to talk offline from this meeting, I'm happy to discuss our specific experience.
Great, thanks, Kevin.
Thank you.
I appreciate bringing that one up. Are there other questions, comments, thoughts as you're kind of listening to all of this? Things that you wish you'd gotten a chance to ask? I will say one question that I had, Tom, is you talked a little bit about affordable housing being hit harder with some of these cost increases than other multifamily properties. And do you have a sense of the magnitude that might be attributable to that kind of?
So I can give you like a rough guess. I want to talk about the reasons first before I give you what I think, and then this is a call out. Like this is why we need the data. We want to be able to really make that case that there is a difference. But things to keep in mind. Call it professionally managed affordable housing versus professionally managed conventional rental housing. We tend to be more stick built, whereas they tend to be more structural steel and concrete. So there is some premium difference because of the building material. You look at the historic patterns of where affordable housing has been developed, and that tends to be in more climate risked areas, and that's color of law and the historical patterns of housing in communities of color around the country. Like that has a factor on rise on the risk as well. And the fact that like a lot of bond deals are being done in QCTs around the country because those you need the basis boost to make it financially viable. But QCTs are QCTs for a reason as well. There's the persistent poverty in those areas brings with it other risk factors also. So you take those factors all together, and then you look at like I didn't share the National Multi-Housing Council's survey from the year before, but I think that it would not be surprising to me if there was a like-to-like comparison, so same construction type, and there's probably a 10 or 15% difference in premiums between. This is just a best guess, but if you look at the asset class to asset class, it might even be bigger than that because of the different construction types and the propensity for wood frame and how that affects the TIVs. So you're more likely to have a total loss on a wood frame building after a fire than you would if you were building with light gauge steel or structural concrete, and that factors into your premium cost.
Andrew, can I just also add just quickly, just that a lot of the factors with Hypex has to do with safety and security in the neighborhoods. They have developed housing, and so a major one of our members in the Tenderloin district is struggling with a range of issues of safety and security and in terms of their property, and that goes to the liability part of this. We've been talking about property. The liability side of things is pretty intense and can create havoc also on your insurance premium. And so that's what we're seeing. The distinction is that multifamily rental housing for nonprofits are serving people who are most vulnerable, most at risk, perhaps more folks who are homeless. Those issues are different than somebody who wants to build rental housing to the general market. And I think there's a big difference in terms of location and who we're serving.
Another factor too, in terms of types of coverage. So, a lot of market rate owners require their residents to have renter's insurance, and that's effectively a first loss line in some cases that comes before their actual policy gets exercised on. And not only is it a profit center for the owners that oftentimes have referral fees and things like that, but then those policies may get dinged for the types of claims that Michael was highlighting, the stuff that may be happening inside a unit first. I'm not sure how measurable a difference that makes, but it is another dynamic that I'd be surprised if the majority of the stakeholders on the call today require renters insurance, or if a large proportion of those renters living in your communities are choosing to get renters insurance.
Michael and Karen, I don't know if you have thoughts on renters insurance or you've looked at that issue. I will say, somebody, we've got 505 units right now. I would say it's a slice of folks who get renters insurance. We don't require it. We encourage it. We encourage people to get it at time of lease up, but we do not require it.
I agree. I've heard, Andrew and Tom, that, having your households have renter insurance is a great backstop and good way to mitigate these premium costs and high deductibles. From what I've seen, I know some partners, to Andrew's point, will include information at a lease signing, pamphlets, agency names and numbers. Strongly encourage it. I'm pretty confident we can't mandate it, but it would be interesting to talk about if you could do almost like a collective program. And I wonder about the analysis if the upfront cost to pay for renters insurance for our households was offset by premium savings or catastrophic loss. I think that would be an interesting thing to explore for sure.
I think if you are operating a property that's got budget-based rent increases, or you could do, Section 8 where you could do a markup to market, you could probably make the case to buy the renter's insurance for your residents and ideally offset it with, a markup or a budget-based rent increase, and that may actually benefit both the renter and the owner. I don't know if others are doing that. We're not, but it's like an idea that we've been, trying to do the cost benefit analysis on to see if that might be one way to get some more affordable coverage that also would protect the residents for other things that may happen, over the course of their lives, that having that additional financial backstop might be helpful for their, financial journey.
Tom, have you heard of federal agencies signing off on such an approach elsewhere in your work?
I have heard anecdotally that people have gotten rent increases for providing renters insurance for their residents in Section 8 properties. I don't know if that's like a thing that's happened once or is regularly included in the rent grid. It may be office to office, but and I'm trying to remember who told me that. I can't, but I've heard that to be the case. And I think Sharon is correct that I do not believe that the I don't believe that the HUD regs or the IRS regs would permit us to require a resident of a Section 8 or a LIHTC property to purchase it themselves. Encourage one thing, but I don't think that we could require it.
Right. Okay. Julie, I see your hand is up.
Yeah, hi.
Hi, Julie. Oh, there you go.
Thank you. So I shared this with the recent housing meeting, but we recently had a property that we updated, rehabbed and added to. It's senior housing, and we had one insurer deny coverage because of the HUD required pull cords that were still in the property and required. And because of which was mentioned, the inflationary cost of construction. So, but at the end of the project, the property was worth something like 3 times supposedly what it was before, or more. But that was, more about the cost inflation than about how much we added to the property, because most of the additions were safety and upgrades. And our insurance from the previous insurance policy to the one after the construction project went up by 5 times. And we only had one eligible, one bidder at the end of that. So it seems like one of the issues that could be really helpful is if we examine the requirements, that especially continuing requirements like pull cords, which are a little obsolete in a digital age, and how those could be waived more easily, because we've requested that, but so far not, I think, received a waiver. And how that also, the other issue there was that we sort of, the value, the after construction value of the property exceeded one of the top insurer on someone's charts, exceeded their limit. So said we used to have insurance through them and suddenly we were outside their limits. So if anybody can comment on those, I'd appreciate it. Thanks.
Tom?
Well, on the pull cords, that's a issue that we hear about quite a bit and have raised with HUD directly. And I know National Leased Housing Association and I think Leading Age have been engaging with them on this as well. I would certainly encourage you to share that information with FHA in particular, and there is a person that's kind of spearheading insurance engagement at HUD right now that more examples of that nature might get them to act a little quicker. That's a common comment that is being experienced across the market, and there's active engagement on that. The changing willingness or the changing amount of limits from insurers, that's like a real issue, and how that aligns with our requirements from our lenders and investors. Just back to that part of the discussion, like we need to get alignment there. A lot of the lenders and investors seem to be willing to at least revisit on a waiver basis some of these requirements when they're not achievable in the market. But my feeling, this is just me, is that if you're waiving the policy for everybody, maybe it's time to change the policy. So good to give again, give your regulators those examples so they can have real examples rather than sort of generic ones in your advocacy.
Thank you.
So Julie, I'll ask the question since I did a building over in New Hampshire. We had pull cords, and we got rid of the pull cords because the town which had previously had the pull cords said, yeah, we pull those cords and they think it rings to the fire station and the police, and emergency services, and we don't monitor it, or we may not know that it's broken. And it was a terrible disappointment for people if they're waiting for somebody to come and then they're not coming because in fact it's not working. So kind of got away from that in a project that we did with one community. So there are some examples out there. Kevin, I see you nodding affirmatively there. I don't know if you've got thoughts on it or have had a similar experience in your portfolio.
Yeah, a lot of the old public housing high rises have the pull cords, and like your example, they open the door, but that's all they do. So when the HUD inspectors came out, their recommendation was just get rid of them, which is sort of a shame because it does open the door, which is some help. But they said no, they either have to be connected to emergency services or just cut the cord and you don't have them anymore. So it's unfortunate, but yeah, I think someone mentioned in this digital age there has to be a better way than just to pull cord off the wall.
Sharon, I know I wanted to ask you a question. We've heard some recommendations on things from Michael in terms of, and Tom in terms of loss mitigation measures. As you looked at that data in the portfolio, was there anything that kind of stood out for you? Something that said, "Wow, here looks to be an area where we can really save some money," or something that property owners can do to sort of try to tamp down some of these increases?
Yeah, thanks, Andrew. That's a great question. I have a couple thoughts on that. In one area, I'm only going to be able to point out the question versus an answer, but a lot of the premiums that were in flood zones, high-risk flood zones, had excessive premiums. And I know that we need to kind of dig in and work with our partners on what flood insurance looks like. Based on the event last summer, we became aware that the flood insurance coverage was not full replacement coverage, and there was a huge window that was not covered. And so really, I think learning, if you are in those flood risk areas, and then understanding your policy. And, on that same note, I think Michael talked about the captive and how they have a great relationship with their brokers and fully understand their policies. I am aware sometimes I've heard of a recent catastrophic event where you tend to default to that Accord certificate, which summarizes coverage, but that's not a binding contract. It's your policy, and sometimes the information on your Accord cert is different than your policy information. So I think as owners and managers, just to be comfortable and understand our policies and what they represent, that can help us manage those situations if we find ourselves where we have to, react and respond and mitigate a catastrophic event. That felt like a big takeaway. I also heard at the national level from a best practice perspective.
Great, thanks, Sharon. So we're coming up on 2:45 at this point, and I wanted to just I think put it in the chat, but if you've got questions, comments, ideas, please, for help, feel free to put it in the chat, raise your hands. Happy to take questions now. Maura, you are going to be, I'm correct, you're going to be going ahead and distributing this recording so that folks want to watch it in the comfort of their home on a Saturday night with a bowl of popcorn. You guys, this is it. You're gonna be able
make sure if you're not already signed up for VHFA's blog, you're missing out on some really riveting information, but we will put it on our blog. So if you sign up to be notified, you'll get an email when the recording of the meeting, as well as any available slides are posted. We're a friendly group, and I'd be happy to put folks in touch with any of our speakers after this if need be.
a really good conversation. And so I'm not seeing hands, but I'm going to talk for 1 minute, and I'm going to thank our panelists. I'm going to thank Tom, Sharon, and Michael for sharing with us today some really great information, some interesting recommendations, both from a policy perspective and obviously from a loss mitigation perspective that we ought to think about. And thank you, Kevin, for your sharing as well. So, Maura, is there anything else you'd like to add at this point?
You've done a great job facilitating this. Thank you.
Okay, well, everybody, we'll give you back your 10 minutes today, and thanks very much for being here with us.
Thanks all.
Thank you.
Thank you.
Thank you.